Good afternoon, and welcome to BakerHostetler's webinar titled When Opportunity is Knocking, Legacy Planning with Low Interest Rates, Volatile Markets, and High Transfer Tax Exemptions. My name is Rob Galloway. I'm resident in our Cleveland office, and I lead the firm's private wealth group. Welcome, everyone. Our other presenters today come from three other BakerHostetler offices. We have John Forster from our Washington, D.C. office, Samantha White from Denver, and Carmela Montesano from our New York City office. We expect the presentation to last approximately 45 minutes. And if you have questions during the presentation, you'll see a chat feature on the right-hand side of your screen, and you can use that feature to submit questions to us. If we have time at the end of the program, we will do our best to answer those questions. And if we don't have time, we still will get back to each person individually with answers to their questions. As for our agenda today, John is going to start us off with a report on current market conditions and the current tax laws, and we'll be followed then by Samantha and Carmela, who are going to talk about planning opportunities. So with that, John, I'll turn it over to you.
Thanks, Rob. Appreciate it. Good afternoon, I guess it is, in most places. Thanks for participating. We appreciate it. What I'm going to discuss, I'm going to take two steps back before I take two into this deck. So first of all, before you're able to transfer a meaningful amount of wealth between generations, there's a 40% federal transfer tax. So if I want to make a gift to a child from a parent, or if a grandparent wants to make a gift to a child, there's a 40% potential transfer tax at the federal level. And there may even be a state transfer tax. So the question is, what planning options are there that I should avail myself of given the market dynamics today? And so many of the planning techniques use as their hurdle rates for success current interest rates and then asset values. And so two of those have been deeply impacted by COVID-19. So first slide here, the June 2020, what's called AFR, the applicable federal rate, and the so-called 75/20 rate are extremely low. So a parent could make a loan to a child or extend a child credit for 3 years at 0.18%. That's the minimum interest rate that can be used for a so-called intra-family loan, a loan between two family members. So if you want to loan a child funds to, for instance, purchase a home, 0.18% is your lending rate. If you want to use the midterm, you want to have a 3 to 9 year loan, you can use 0.43%, long-term 1%, which is past 9 years. And the so-called 75/20 rate is 0.6%. So just the simplest transaction, if you loan a child money for 3 years and you believe that that child could achieve a rate greater than 0.18%, then that's a successful wealth transfer. So let's say I loan my child $1 million, they go and invest that $1 million at 5%, then they've in effect achieved success. The difference between what they're paying me, 0.18%, and the 5% internal rate of return is what's been transferred tax-free. Next slide, please. So asset values also play a pretty big role in all of this. Needless to say, when you transfer an asset to a different generation, a child, a grandchild, your hope is that the asset will appreciate in their hands over time. And so before COVID, call it, let's say February of 2020, the Dow was nearly at 30,000. It's dipped as low as 18,000. So when you're riding these dips, it's obviously, or maybe not obviously, but it's opportunistic to move assets during these dips so that you can generate appreciation in the hands of the recipient. And this applies to asset classes like real estate. Commercial real estate's a good asset class to look at. Private equity, if you've done a sale of your business and you've taken back, rollover equity, or you've invested in a private enterprise, those assets have likely also been affected. So those assets are prime targets for future appreciation, and those are assets that I would think would be subject to type of gifting, lending, or selling for transfer tax planning purposes. Next slide. So just to give you a sense of how much these rates have changed over time, if we were together and it was 1989, it was 11% was the hurdle to achieve a wealth transfer or financial success with one of these transactions. 1995, 8.2%, just as little as 2000, it was 8%. And today, the so-called 75-20 rate is now standing at 0.6%, which again is a rate that's often used for trusts that are called GRATs, or charitable lead annuity trusts, another type of trust called a CLAT. So that's the hurdle rate to have success. So if you believe an asset that you have in your hands will appreciate at a rate greater than 0.6%, then that's a prime asset to be moving to a child. All you have to do is beat 0.6% over time. And I would argue that most people that are holding any asset class, unless they're completely not bullish on any of their assets, believe that 0.6% is an achievable internal rate of return. Next slide. Also, you're able to transfer wealth up to a certain limit without triggering a transfer tax. Now that limit, called the exemption, was at one time in 2001, $675,000. So that was the amount of assets that you could transfer without paying any transfer taxes at the federal level. Then it moved in 2002 and 3 to $1 million, 4, $1.5 million, 9, it jumped to $3.5 million. Then 12, it went from 3.5 to $5 million. And then suddenly in 18, it jumped to $11 million per person. So if you're married, you have the ability to transfer roughly, call it $23 million without paying any transfer tax. Now you might say, if that's the case, I don't need to do any planning. $23 million, I'm good to go. On the other hand, if you're north of that number, you have a transfer tax, and the only question is how much is it? However, everything on the personal side of the Trump Tax Act, which created this substantial number, is all temporary. It's scheduled to sunset as of 12/31/2025, assuming no further changes until then. But this number, this $23 million for a couple or 11.5 for a single individual, is all temporary. So again, if you're looking at sort of the perfect storm, if you will, low interest rates, depressed asset values, very high transfer tax exemptions. That's the dynamic you're operating in or could operate in today. Next slide, please. So why don't I just wait? Let's wait and see. I mean, this whole COVID pandemic, let's see how it plays out. I'm a little concerned that I don't have lots of visibility into the future. Maybe you can wait and see. But here are the risks you're undertaking if you decide to do that. Maybe rates are at their bottom and they're going to increase. Maybe the Dow is going to bounce back. It already has to some degree. It's definitely not at its low anymore. And again, the exemption sunsets 12/31/2025. And lastly, maybe there's a change in tax policy. I mean, keep in mind, we've been spending on a lights out basis to support the economy. There's no way this is sustainable. And one question will be whether our tax policy is sustainable or whether there's going to need to be a change. Next slide, please. By the way, a favor for those of you that are out there listening to us, I don't know if somebody has an open mic, but if they can put themselves on mute, I'm starting to hear some background feedback. So question is, what do I do? And I'm going to turn it over to my colleague here. Carmela, I think you're next, or is it Samantha?
Nope, I'm next.
Oh, Sam's going to go next.
Sam?
Yeah, okay.
Go ahead.
Yep. Thanks, John. So first and foremost, we want to make use of these incredible lifetime exemptions of $11.5 million per person if you have the resources to do so. As John stated, they're set to expire on December 31st, 2025 to around $5.5 million. If Democrats end up controlling Congress and the presidency, there's many commentators that believe these exemptions could be scaled back much sooner. And this is a topic that's constantly in the news. In fact, I just saw an article last week in the New York Times that was advocating for returning to 2009 levels of exemption, which were $3.5 million, because it would generate $270 billion over the next decade. So again, as John said, with the pandemic stimulus payments being made, it's likely that in order for the government to generate revenue going forward, that this item would be on the chopping block, would be the state tax rate. So if you're the head of a family office or a client or an individual with clients who are high net worth and who have not made use of your exemptions, or you may have made use of the exemptions in 2012 when they were 5.12 million, but have all of your increased exemptions of about 6 million left remaining, you need to be seen in the State Planning Council now. A lot of these transactions require some time to appropriately plan and season assets and get other items arranged, like consents of various shareholders if we're transferring closely held businesses. So you need to be starting now. And again, timing of a gift is better when values are depressed, assuming you believe a recovery will follow. I saw an example the other day where one person had done nothing, another person had made a gift in 2019, and another had done a gift in 2020. And assuming that the economy dipped and then came back, the person who made the gift in 2020 was better off by about another $1.23 million. Again, also, the IRS last year, at the end of last year, issued the final notice stating that if you use the exemptions now at these higher rates and later the exemptions drop, there will be no clawback on the amount gifted at higher rates. That's because the amount governing the computation of the estate tax will be the greater of the exemption at date of death or the applicable exemption actually used before 2025. So we view this as an opportunity to lock in exemptions at these higher rates because under current law, it really is a use it or lose it scenario. And finally, this isn't just for the ultra wealthy. For my clients with $30 million and under, they would look at me like I was crazy if I told them to consider taking $11 million off their balance sheet and gifting it to trust for their kids. There are other gifting strategies that may make sense for those couples to use the exemption, such as a SALFA lifetime access trust or other avenues as well. So again, not just for the ultra wealthy people. Okay, next slide, please. Family loans. So this is a really simple way to make use of these historically low applicable federal rates, lowest in 36 years. It could not be a better time to utilize the bank of mom and dad than right now. It just requires a promissory note between family members or between the trust and the beneficiary for these interfamily loans. If you have a child that is considering, for example, buying a home, maybe they want to refinance their current mortgage with a bank, or they're starting a business, you can prime pump them with a loan at 0.43% if it's a 9-year note, or 1.01% if it's longer than 9 years. This example shows $1 million mid-rate note of showing 0.43%. The interest on that is $4,300 a year. It's incredible. As long as you use the applicable federal rates, there's no transfer or gift tax implications for these interfamily loans at these incredibly low rates. Also, if a child has a trust for his or her benefit, consider making a loan rather than an outright distribution from that trust, particularly if it's a GST exempt trust, because we want to have an avenue to get those funds back into the trust. And at these low rates, the child can likely make at least the interest-only payments for a number of years and could probably support principal as well. Bullet number 2 on this slide shows that if a parent lends money to a child and then the child goes and invests the funds in the market or another asset that earns 5.8%, again, if they're borrowing at 0.43%, the excess accrues to them free of any transfer taxes. Next slide, please. So we have a lot of clients that have existing family loans or loans from trusts, and they're interested in refinancing at these lower rates. Can you do that? There isn't a lot of guidance in this area. Proposed regulations under Section 7872 include a section titled Treatment of Renegotiations, but it just reserves the subject for later guidance. Most commentators agree that refinancing is possible, but there's some things you want to consider. Next slide, please. We want to see adequate incentive for the lender if they're acting objectively to refinance. So if I'm a trustee that has an existing loan out to a beneficiary or a grantor of a trust at 5%, how do I justify from a fiduciary perspective refinancing the loan to 0.43%? If I just refinance every time the grantor asks me to, you risk the IRS coming in and saying, look, this isn't a loan at all, or you didn't really make that earlier gift to the trust because this is your money and the trustee is just doing whatever you asked with it. So it risks blowing up the trust. Depending on the loan, what we'd like to see in terms of attractive incentives for the lender are maybe a payment of a chunk of the principal down so it reduces the total obligation on the note, a personal guarantee, maybe additional collateral is offered. As well, you can also, in terms of the refinancing, break the note down into 3 different notes that are laddered in terms of rates and in terms of the loan term, but it reduces the effective rate of the loan overall. Either way, we want to see appropriate consideration for the refinancing, particularly if a trustee is involved who has fiduciary duty to protect and grow the trust assets for the benefit of a beneficiary. You don't want to be in a position where the trustee is simply rubber stamping a refinance every time that low rates are involved. And again, it's best to document these loans with trustee resolutions. Many beneficiaries may be in a position due to the pandemic that a loan to them would make sense, and adding those facts into the resolution is a good idea. Next slide, please. I know we have kind of a wide audience today, which is a mix of clients, but also those who operate in this space and are more familiar with estate planning gift strategies. So let me just take a step back and state that when we talk about a sale to a grantor trust, we're talking in this context about a sale to an intentionally defective grantor trust, also called IDGTs or IDGTs, okay? This is a trust that's outside of the grantor's estate for estate tax purposes, but the intentionally defective part is that it's inside the grantor's estate for income tax purposes. Why would we do that? Let's take an example where we use a grantor's exemption of 11 million of assets and put them into a trust. We've used the exemption, so it's outside of their estate for estate tax purposes, including all the appreciation on that asset. But we've added certain powers into the trust agreement known as grantor trust powers that make all of the trust income taxable to the grantor. This allows the trust to grow income tax-free and allows the grantor every year to further reduce his or her own taxable estate by paying the income taxes for the trust, and it doesn't use their available exemption. It's effectively a way to make tax-free gifts every year. So my $11 million, if it earns $500,000 in income each year, and the grantor pays taxes on that income of $200,000 each year, after 5 years, I've reduced his or her taxable estate by $1 million, and is all accrued for the benefit of his or her heirs. So recognize as well that when we talk about selling assets to a defective grantor trust, there's no capital gains tax or ordinary income taxes on the sale, because for income tax purposes, it is as if the grantor is selling those assets to him or herself. Now, due to the very low interest rate, I can sell assets to a trust for a promissory note and whatever security I want to take against the asset. So as shown in this example, I put $126.5 million into the trust. 11.5 of that was using the grantor's exemption, as we talked about, into the trust. Do we need to do that? Yes. You wouldn't sell assets to a party with nothing to be able to repay you. So if you have a new trust, it needs to have adequate seed capital, and you can do that through a gift. Or if you have an existing trust with sufficient assets, then you may not need any further seed capital. We generally like to see at least 10% or more. And then we sell the balance of the assets worth $115 million for a note at 0.43%. That's the current midterm rate for 9 years, or you could do longer with a slightly higher rate of right now, which is 1.01%. The assets earn an internal rate of return of 5% for 15 years. So after that 15 years, I now have $144 million in the trust. I have transferred $57 million free of federal estate tax. The other thing I like about sales to defective grantor trusts, with the uncertainty around if and when the exemptions are going to drop, is you can get the loan in place, do your transaction now, get it all done with your appraisal, freeze them at these lower values today. And if the exemptions drop, you've frozen that asset value and can later gift the note balance if the exemptions are reduced. The best assets to consider for these are minority interest in closely held businesses or investment entities, or fractional interest in real estate for which a discount may be available. Gifting at a discount allows the gift transfer of more assets for the same amount of exemption, since more property is at work. You can also structure these types of loans with an LLC or an entity that uses 1% Class A voting rights to the grantor and 99% Class B non-voting rights that are gifted, and thereby the grantor can maintain control of the LLC assets via their voting control of the LLC. So next, Carmel is going to talk about a few other strategies to think about in terms of GRATs and CLATs and other items.
Thank you, Sam. The next slide, please. The third opportunity we would like to discuss with you today in our webinar is the GRAT, the Grantor Retained Annuity Trust. This device requires the creation of a trust. That trust is essentially simple to draft. It is a conservative approach, and the hurdle rate for a GRAT is only 0.6%. So success is achieved on a GRAT where the income and the appreciation on the assets that were transferred to the GRAT exceed the hurdle rate. Next slide, please. This slide shows how a GRAT might work. A taxpayer called a grantor would create a Grantor Retained Annuity Trust and take back a guaranteed annuity for a period of years. The value of the annuity would equal the value of the assets that were put into the trust plus the hurdle rate. Any assets in excess of the hurdle rate would, at the end of the term, pass to the remainder beneficiaries. In our example, the grantor here transfers $10 million to a 2-year zeroed out GRAT at the June applicable rate of 0.6%. Assume for this slide that the assets transferred to the GRAT increase by 5% each year for 15 years. The math is as follows. In year 1, and then again in year 2, $5,045,154 is paid back to the grantor. So what the grantor put in plus the interest rate goes back to the grantor. On this example, it would leave $682,434 to pass to the GRAT remainderment. That's the net amount that passes gift tax free. Fast forward to year 15, based on our calculations here, the assets in that trust would be worth $1.286 million. So the beauty of the GRAT is its simplicity, it's conservative, it's approved by statute. 3 planning notes here. The first is the remainder beneficiaries. At the end of the term of the GRAT, the assets can pass outright to the individual beneficiaries. Or, to enhance the performance of the GRAT, they can be passed to an irrevocable grantor trust for the benefit of the same beneficiaries. As Sam described in her presentation, the value of using the irrevocable grantor trust structure is that the assets will then, the grantor will pay the income taxes and the assets in the trust will grow income tax free to the beneficiaries. Use of that type of a trust is one of the greatest enhancers to pass wealth tax free. The second thing, on this particular example, we said that it was a zeroed out GRAT, meaning that the value of the taxable gift is minimal, if not nil. And so the beauty of this type of a device is that even for clients who have used their exemption amounts, this is still another device that they are able to use. The third planning suggestion is, what are the best type of assets to be placed into a GRAT? The best assets are assets that are easy to value, such as marketable securities, as opposed to hard to value assets like private equity or real estate. The reason for that is as the assets go in and out of the trust, they have to be valued. So in order to do that, it's more cost efficient to use easy to value assets. Next slide, please. So while GRATs are simple to effectuate and conservative in approach, they do need to be proactively managed. The first thing is that the annuity payments have to be made back to the grantor in accordance with the terms of the trust instrument at the specified time periods required. so they must be monitored. The second is they must be managed in terms of performance. For example, a GRAT may do, let's go back to our 2-year GRAT, but in the first year, that GRAT may beat the hurdle rate, or alternatively, it may not beat the hurdle rate. And so how do you manage that performance? Typically what is done is in the grantor, in the grantor retained annuity trust, the grantor retains a grantor power known as a swap power, or a power of substitution. That power allows the grantor to swap the assets that are in the trust and in exchange for assets of equivalent value. In the article that's referenced on this slide 16, you can see this is a Bernstein article, and here they discuss the planning approaches of what you need to do to manage the performance of a GRAT. In the first place, they talk about an out-of-the-money GRAT. This is a GRAT that doesn't meet the hurdle rate in its first year. In this example, the author is saying if you have a 2-year GRAT invested in equities for the entire term that delivers a return between 20 to 10% below the 75-20 rate, it has only an 8% chance of succeeding after the end of the first year, meaning it has a 92% chance of failure. So if the grantor was to exercise his or her power of substitution, take the equities out of that trust and put them in a new GRAT, according to Bernstein's study and this article, that new GRAT would have a 62% chance of succeeding. The in-the-money GRAT is a GRAT that goes the other way. It outperforms the market way greater than anyone had anticipated. And here, the grantor may decide that they want to lock in the value, they want to pull out their winnings, they don't want to wait and see how this all works out, and then they can immunize that GRAT by putting in bonds and cash and pulling out those high equity assets. So clearly, this type of a device works well, but it must be actively and proactively managed. Next slide, please. The CLAT is the charitable lead annuity trust. It is similar in concept to the GRAT, except that the lead interest passes to one or more charities, and with the remainder interest going to family members either outright or in trust. The CLAT is a very unique type of trust because this is the one place in the Internal Revenue Code where a grantor can satisfy both their philanthropic and tax transfer objectives. You are allowed to have a split interest trust for a fixed period of time, the interest going to the charity, and then at the end of that term, it passing to your family members. The hurdle rate for the CLAT is just like the GRAT, it's the 75-20 rate, but here again is a unique opportunity for this type of a trust. The grantor is allowed to select the 75-20 rate that either in the month of the creation of the trust or 2 months back. This allows for an uncommon opportunity to calibrate the tax effects for the best taxable results. In addition, based on the type of CLAT that is created, income tax deductions may be allowed as well. Next slide, please. This slide is an interesting slide because it shows why a CLAT is referred to as a GRAT corollary. Here we took the same numbers as we did in the GRAT example. We had a grantor who transferred $10 million to a 2-year CLAT at the 75-20 rate. And the numbers, if you were to go through them, you'll see that it's the same exact result. The same amount comes back is paid to the charity, with the remainder interest going to the remainder beneficiaries. Of note here is the bottom of this slide, which shows again that depending on the structure of the CLAT, the grantor may receive a $10 million income tax charitable deduction. So the use of a CLAT is very, very useful for a client who is interested in this type of planning. Next slide, please. Under the CARES Act of 2020, the individual adjusted gross income limit was lifted from 60% now to 100%. This applies only, however, to gifts to public charities, not private foundations or donor-advised funds. However, if you have a client who is a high income earner or perhaps an executive who's is retiring with a huge bonus payout, this is something that they may want to be considering. That 100% is at a historic high. Next slide, please. The sale of a GST non-exempt trust. So this fifth opportunity that we're discussing today is for clients who have multiple irrevocable grantor trusts, some of which are exempt from the federal generation skipping transfer tax, and some of which are not. Here, the non-exempt, if the non-exempt GST trust has assets that have appreciated, they can sell or loan those assets to a generation skipping transfer trust, thereby moving the appreciation from the non-exempt trust to the more favored GST trust. This example is essentially what Sam was describing earlier in terms of the loan technique. And again, as John mentioned earlier, depending upon how long the note is, the AFR rates are incredibly low. What this slide establishes is that proactive management and a disciplined approach is key to estate planning. It's not that the documents are created, the trusts are funded, and they sit there, but proactive management is required. Next slide, please. This sixth opportunity is available or applicable for a client who has unused GST exemptions with irrevocable trusts that are not GST exempt, such as an old GRAT or a flawed life insurance trust. Here, a client with an unused exemption could make a late allocation of GST exemption, and that allocation is based on the value of the assets that are in the trust as of the date of the allocation. What that is particularly significant today, where asset values are low and the exemption rate is high. So the GST exemption amount this year is 11.58 million, and it tracks the same schedule that was John discussed earlier today. Next slide, please.
Thank you, Carmela. This kicks it back to me. We wanted to be sure to make everyone aware of the BakerHostetler Coronavirus Resource Center. This can be found at our website. And this resource center contains a multitude of articles, blogs, events, all relating to issues arising from the coronavirus. And this website is updated regularly by our lawyers throughout all our different practice groups. So it's a wonderful resource, and we invite you to use it. With that, I'm looking to see what our questions are here. And we do have a few. One question reads, have you seen situations where a client borrows money from a third party to re-loan the funds to family members? John, that sounds a little bit like what you were describing in your presentation. Do you want to add a little color to
that? Sure. You can certainly do a back-to-back loan. So just making this up, if a client has an investment account where they can collateralize their securities, which most can, and let's just say that they can collateralize their securities and borrow at a rate of 1%, which is roughly what I'm seeing these days, private banks. You could go ahead and take those loaned funds and, in effect, further lend them to an irrevocable trust for your children and or grandchildren. And so in effect, you are borrowing the funds at 1%. You can extend the loan at a lower rate or at the 1% rate. And then the question is, will those funds in the hands of the trustee achieve an internal rate of return higher than the 1% at which they're being borrowed at? And if the answer is yes, then let's just say, in my example, all of those funds would be moved transfer tax-free to the next few generations. So the short answer is you can do that.
have you seen situations where people get in a bind when they owe the money back to their lender, and for example, they borrowed on margin and assets have dropped, and all of a sudden there's a call on the loan? I mean, I've seen that situation, so you put yourself a little bit at risk there.
Certainly, you could be, but honestly, you generally can't borrow much more than, I believe, 50% of the asset value. So you should have a fair bit of cushion there. But sure, I mean, you are taking some risk. There's no question about that. If it's an all concentrated stock position in a single stock, there's more risk. It probably depends a bit on the assets that are being borrowed against. Probably a diversified portfolio should be a relatively low risk proposition.
Mm-hmm. So we've got a few more minutes left, and I see 2 more questions. Why don't we keep going with the questions? The next one is that you described sales from one trust to another. Are there particular issues when both parties are the trusts? And I think, Carmela, you touched on this a little bit, but do you want to expand on trust-to-trust sales and what kind of issues we run into that might be different, for example, than a sale from a donor to an intentionally defective grantor trust?
Yes, definitely. So yes, there are definitely special issues with the sales from another. First, you will want to make sure that both trusts are applicable to your trust. Second, when trusts are involved, there are fiduciary issues which would need for fair market value appraisal. And third, that we encounter a lot, Bob, is we look to see whether those types of transfers need to be reported on gift tax returns. So typically, you would want a sale from a grantor with his or her grantor trust report for disclosure reasons. But in this type of case, where it's trust to trust and the trustees are engaging in the transaction, there should not be a need to file a return and report that.
Thanks, Carmela. Yeah, I've seen several of these recently, and that question that you focused on at the end about is there a gift tax reporting either required or even potentially is a tricky one because we don't have a donor to file a gift tax return. So I've come to that same conclusion. We were having a little trouble hearing you in the beginning, Carmela, and I wasn't able to hear your first point, but I thought it might have been, and I'm not sure, but if you have a sale from trust to trust, we would typically want each trust to be a grantor trust as to the same grantor so as not to trigger capital gain. But I'm not sure if that's what you mentioned in your first point. I couldn't hear it.
My apologies. Yeah, I seem to be having.
Great. Lastly, Sam, do you want to try this one? Of the strategies described, GRATs and DGTs, why would someone choose a GRAT over a DGT?
Yeah, so if the donor has no remaining exemption, then a GRAT is a good idea. So for clients that have already used all of their, their couple's 23 million and they want to do more gifting, then we look at GRATs. Again, as John described, with that hurdle rate of 0.6%, it's crazy, right? Anyone would think that they could probably do better over a period of time, if you're bullish on the markets and think that there will be a recovery at some point in the long term. GRATs are also condoned under the Treasury regulations, so there's very little risk to them. If you have a risky asset that could have a loss in value, then a GRAT may be a better choice because there's no tax consequences to a failed GRAT, where a defective grantor trust is going to have that promissory note that needs to be repaid in some manner. If it's not repaid, then it would be discharge of indebtedness or a gift, which could be a bad result depending on what you're looking to do.
Super, thank you. Well, that takes us to the end of our presentation. We're a couple of minutes early, but we thank everyone for joining us. I think it's evident from what we heard today that there are opportunities in this current market and current tax situation. And each one is really very dependent on a client's situation. So we've got a nice menu to choose from, let's say. So with that, I think we'll sign off. Thank you, John, Sam, and Carmela for your presentations. Appreciate it. And thanks everyone who joined the webinar. We appreciate that for BakerHostetler. Have a great afternoon. Bye-bye.
Everyone, bye-bye.
Bye.
Thank you.